Colin Murphy from the Dassault Systems Human Resources team. I am pleased to have Kendall Storch from Longfellow Benefits with us today. He will be doing our presentation on the second half of 2015. I'm glad that you're all able to make it. We've got a great turnout for this presentation. Please note all of your lines are muted. If you do have any questions throughout the presentation, please feel free to type those questions in, and we'll try and get to as many of those questions at the end of the presentation as we can. If you have questions beyond that we don't get to today, or if you have individual or personalized questions that you'd like to direct to Kendall, you are more than welcome to do that, and I'm sure Kendall will have his contact information available to you in this presentation. So with that, I'll turn it over to Kendall.
Great, thank you, Colin. I appreciate it. Good afternoon, everyone, or perhaps still good morning to some people on the West Coast. Thanks for taking some time to dial in and listen to our third quarter 401k update for the Dassault Systems 401k plan. I'm going to move to our agenda slide here and talk a little bit about what we'll be covering today. So first off, we'll give everyone a quick update on the markets through the first 9 months of the year. So we'll cover through Q3. I do have a couple of comments about kind of where we stand today, but the bulk of the discussion will be sort of what was happening throughout the summer and early fall months. We'll take a look at the performance on the funds within the Dassault plan. I'll make a couple comments on a few of the funds just to give everybody a little bit of color in terms of what's happening, maybe with some funds that are doing particularly well or some funds that are lagging. And then finally, we'll wrap up with some thoughts about ways to think about your portfolio as we get into kind of choppier markets. Certainly September and kind of late August, I think, brought back memories of more difficult markets, more volatile markets for people. So we thought it would be timely to remind people of some strategies and some things to keep in mind, particularly if we see more volatility in the markets going forward. So once we're done with that, we'll open it up for some questions, and we'll do our best to try and answer as many as we can as time allows. So that's basically our agenda for the day. I'll move to our first slide. So we'll talk a little bit about the markets. So just putting third quarter into context and some key bullets, I guess you could say, about what was happening. So as people are probably aware, the markets took a bit of a nosedive in September. The size of the pullback that we had in the market was about 12%. So this was the biggest pullback that we've had since 2011. So it was certainly meaningful. I think one of the things that we'll look at is that pullbacks of this nature are not uncommon. While this one was particularly big, we see pullbacks every year of varying different sizes and shapes. So, you know, the fact that we saw the market give up some ground, not uncommon by any means. A lot of the reason that the market turned negative third quarter was around China. So we'll talk a little bit about kind of what was happening with China that made the rest of the global markets kind of scratch their head and maybe rethink where the global economy is headed. We also had a fair amount of fretting, I guess you could say, about when the Fed is going to raise rates. We were certainly expecting, I think, the Fed to do something in September at their last meeting, which did not happen. So that has sort of led to continuing kind of conjecture about when the Fed is going to make a move and begin to raise rates. So while we thought we would have some certainty around that, we didn't actually get it. And if there's one thing that the markets don't like, it's uncertainty. So, you know, some thoughts about what we can kind of expect. You know, one of the things that people were trying to figure out in September was, you know, is this the beginning of a bear market, or is this merely just a sell-off or a short-term downdraft? So, you know, at least as it relates to bear markets, we really don't see them very often. They're pretty unusual, and they usually only occur when there is some sort of a recession in the economy. So we aren't really seeing that out there on the landscape. So we'll talk a little bit about more of these kind of pullbacks or downdrafts. When we look at valuations on stocks, even when we sit here today, valuations do seem reasonable. They certainly got a lot more reasonable in September, and we'll take a look at what those numbers look like. And then, the diversification element really is important, and keeping the long term in mind. We'll cover that as part of our segment on things to think about when markets get more volatile. But these things do really matter. So some return figures, both for Q3 as well as year to date. I think what you'll note here is that pretty much anything outside of bonds, any sort of stock-related investment, basically had negative returns for Q3. So there was very few places to escape, I guess you could say, for third quarter. Really, the only thing that had positive returns is the more defensive items, such as high-grade bonds, either corporate bonds or government bonds, or some real estate stocks that may have sort of a feel to them, kind of like bonds with a higher dividend payment. Those are the things that managed to eke out a positive return. But basically, after you got away from that, the returns began to trail off, and in some cases pretty dramatically. So, why? Why did we see this pullback? I think you can really kind of see it comparing these two charts. So on the left-hand side, let me put us back into the slideshow here. On the left-hand side, what we're looking at is the value of currencies related to the U.S. dollar. So you can see on the green line, which is the Chinese currency, that there's a significant drop right in and around mid August or early to mid August. If you look to the chart to the right, this is what they call the VIX index. So the VIX index tracks volatility. Sometimes they call it the fear index. So as the VIX rises, that tends to mean that there is more concern out there on the part of investors. So it's not surprising that we see a large spike in the VIX right in and around the time that we see the Chinese government devaluing their currency. So that really kind of punched a hole in the balloon of the markets in mid-August, mid to late August, where everybody began to kind of rethink, hey, we think the global economy is improving, but if China is going to devalue their currency and try and make their goods less expensive relative to other countries' goods, that maybe that creates something of a trade war, maybe that makes other countries' goods more expensive, makes U.S. goods look more expensive as well. So that, I think, was a bit of a curveball, and the markets had not necessarily seen that coming. And as a result, like I said before, the markets don't like uncertainty. With that, we see a spike in volatility. So as I was saying before, when we look at U.S. stock market returns, not a lot of places to hide. REITs were about the only thing that eked out a positive gain for Q3. And basically, the smaller the size of the company that you were investing in, the worse the returns got. So sort of best place to have been would have been large cap U.S. stocks, down 6.4%. As you got into medium-sized stocks and small stocks, the returns trailed off substantially from there, with small caps, not quite, but almost down double what large cap stocks were. So as you're looking at your portfolio, and maybe as you're looking at your returns for third quarter, the more you had in small cap, chances are the worse the returns. Another place that's kind of interesting to look is different industries. So how did those industries perform? So the takeaway here was really anything defensive, anything that tends to do well when the markets are doing poorly, or industries that tend to not really be bothered by what's happening in the economy. Those were the ones that did well. So utilities was our big winner, up 5.4%. Consumer staples, that would be food, that would be funeral homes or something like that. Consumer staples also held up very well. Those are, again, historically very defensive types industries or defensive type stocks. The things that did not do well are the things that tend to be more what they would call cyclical, or things that tend to be more influenced by the comings and the goings of the economy. So materials, anything having to do with building or construction, those sort of things tend to be very economically sensitive. But the big loser, and kind of has been this way for a while now, has been energy. So energy was down 17.4%. I saw an interesting statistic about looking at the earnings growth rate for the S&P 500 index during Q3. So the earnings growth was down about 1.2%. But if you took energy out of that equation and you looked at the S&P 500 index minus energy, the earnings growth rate was like a positive 5.9%. So energy is a big piece of the S&P, and it definitely was weighing on the S&P's returns based on not only its weighting in the index, but also its results. So energy, at least for the first 9 months of the year, was something of a third rail. The more you had in energy, the worse the returns. Okay. I'm kind of, I guess I kind of let the cat out of the bag here a little bit, but this is, again, another way of looking at that, where as we look at earnings growth, or per share earnings growth, you can see in green is the S&P's numbers. The orange triangle is the energy sector. So you can see how energy's earnings per share growth has been drifting off precipitously, and that's been kind of weighing on the overall return of the S&P. All right, so one might ask, so in light of this, where do stocks stand from a volatility, or from a valuation perspective? So even with kind of everything that's been going on, valuations still are not, out of sight by any means. Clearly, here on our graph, we've got information back to 1976, so we've got a long stretch of time. But you'll see the long-term average of the S&P's P/E ratios going back to 1925 has probably been around 13 times earnings. That's the yellow line. So we're above that. But the 20-year average, we're right there. So the profile of kind of what the S&P looks like is very different than if we look at the internet boom, which would be 1995 to 2000. Where you can really see valuations getting way out of whack. And of course, when anything gets way out of whack, it tends to revert to the mean and come back to its normal range. So, I think we're really starting to see that with the graph. You'll see how valuations got super duper cheap out of 2008, and we've been slowly kind of making our way back to kind of the 20-year norms. Let's on the international front. So I've been talking primarily here about the U.S. If we look abroad, kind of what was happening there, kind of definitely a worse situation, I guess you could say. So the standard index that we would use for international markets, that would be kind of closest to what we use for U.S. markets, being the S&P 500 index. We tend to look at this EFA index, which is the orange bar chart to the left. So the EFA index was down about 10.2%. I think we said the S&P was down about 6% for the quarter. So international markets fell further than U.S. markets. As you get further away from developed countries and you start getting into emerging markets, the numbers get much worse from there. So the emerging markets index was down about 17.8% for the quarter. So again, as you're looking at your portfolio, and if you happen to have a lot of money in perhaps our emerging markets fund, the Oppenheimer fund, that might be a bit of an explanation as to what was going on with your return. Or if you didn't have much in the emerging markets fund, that would also be something of an explanation for the return on your portfolio. Couple of other little thoughts is certainly there's been a lot of dialogue these days about when is the Fed going to make a change with interest rates. We are sitting today at historical lows. Interest rates are effectively zero. That has been the government's way of trying to spark the economy and make the economy as accommodative as possible to try and grow. But the danger with that is if we see the economy begin to slow down, the Fed does not have many bullets in their chamber of things that they can do to try and spark the economy. So in general, the consensus is, although it's nice to have very low interest rates, we'd like to have some dry powder. So it would be good for the Fed perhaps to begin to slowly raise rates back up so that they have some sort of tool to use if the economy begins to slow down. The downside with rising interest rates is that A, it tends to negatively affect bonds, and B, it tends to negatively affect smaller company stocks or small cap stocks, where you have companies that are much more dependent on lending. They need lines of credit from their bank or their lenders, and those are going to be affected by rising interest rates. So it's interesting to look at this chart in terms of kind of what to expect in the months to come after we see the Fed raising rates. One would think with the various different headlines and the news reports that the world is going to come to a screeching halt once the Fed begins to raise rates. In fact, what you tend to find is that the markets tend to be in much better shape 6 months after the fact, 12 months after the fact, 2 years after the fact. So Fed tightening is not necessarily a bad thing. On the bond front, so if we look at fixed income, where was there positive and negative? It definitely fell along the similar lines as stocks, that the more defensive bonds were the ones that tended to do the best. So things like treasuries, things like longer-term government bonds or longer-term high-quality bonds basically led the charge. The things that did not necessarily do so well would be bonds that are more sensitive to the economy. So high-yield bonds gave back some ground. Emerging market debt or emerging market bonds, obviously, with the returns that we saw on the other page about how emerging market countries were doing third quarter, it's not surprising to see that emerging market country bonds also didn't necessarily do so well. So the more defensive stuff was the winner again on the bond side, just as it was on the stock side. So if we pull out our crystal ball and try and look towards some projections. There's some thoughts about fourth quarter of this year, so the remainder of the year. Couple of sort of interesting bullets to think about. So this has been the third quarter was the 8th time since 1990 that we had the stock market down by at least 5% during third quarter of the year. So going back to 1990, that's not that frequently. If it's just the 8th time, more often than not, the market has been up and down. But if we look at once we have a down market for third quarter, during fourth quarter, 6 out of 7 years, the market was up again, fourth quarter. And there was only kind of one time, I think during that period, that was 7 years, which was fourth quarter of 2008, which is about as bad as it could possibly get, where the market did not rebound during fourth quarter if it had a negative third quarter. So tells you a little something about the elasticity, I guess you could say, of the markets, particularly at this time of year when we're coming into the end of the year. There tends to be a fair amount of spring during fourth quarter. So during those 6 out of 7 years where we had positive returns, average return for that 3-month period was nearly 12%, which is a very healthy number. And then, like I said before, it's not often that we get negative returns. So we only had, during fourth quarter, we only had negative returns in 5 out of the last 25 years where fourth quarter's return was in negative territory. So as I look at my crystal ball and some of these historical facts, I guess you could say the outlook for fourth quarter is much more encouraging than what we saw for third quarter. So some things to keep in mind. We have, I would qualify this as cautious optimism. Certainly the statistics from the previous slide would paint a pretty rosy picture, but I think we have to take all of that with a bit of a grain of salt. But that said, even with some of the volatility that we've had and that spike in the VIX, there's still a lot of very positive factors out there that are helping the U.S. economy, whether that's an improving jobs outlook. Our unemployment rate is hitting 6-year lows, whether that's inflation, where there is practically no inflation, whether that's corporate earnings, which also are improving and holding well. So some of the key tenets or components of what makes the economy move forward seem to be intact. So that is definitely something to rely on. The Fed, for what it's worth, even though they've been delaying raising rates, the rationale for the delay is because they haven't felt like they needed to, that the economy was moving along at a strong enough pace where they didn't necessarily need to make any sort of adjustments. I think part of the reason that they might make adjustments in the future is not so much about what's happening currently with the economy, but it's sort of pre-planning for the future where, if at some point in the future the economy heads off the rails, they want to be able to try and affect that in some way, shape, or form. They can't really do it right now. If we look at, so we spent some time looking at valuations of U.S. stocks, which seem pretty fairly valued. As you get outside of the U.S., if you look at valuations in the UK, in the developed countries in Europe and Japan, many of these countries look pretty cheap. So there's some opportunity there abroad. We do think that we'll probably continue to see volatility going forward, that these sort of bumps in the road will probably become a little bit more common than what we've seen over the past 3 years. So we're preparing for that, and I think that's sort of the gist of our message as we get further into the presentation. So, rate rise, will the Fed actually begin to raise rates? We do think so. Even the headlines today were indicating that the Fed is feeling pretty good about trying to put a stake in the ground during their December meeting. So that will be an interesting test to see how baked in a rate rise, maybe 0.25% rate rise is into the markets. We may see the Fed raise rates and the market really not do very much because everybody is expecting something to happen in the relative short term. All right, so enough market overview here. Let's take a look at some return figures for the Dassault plan itself. So I've got a few different slides for us to take a look at. The first here is looking at some of the different funds that we have in the plan. It actually spans 2 different slides, so that these are not all of them. I have the 3-month return through the end of September, and then I have the year-to-date return through September, as well as the year-to-date return for the peer group, which would be the average fund, like the fund that we're looking at. So I'll give you an example of that. Let's start with the first one, Oppenheimer Developing Markets. So Oppenheimer has struggled somewhat this year. Oppenheimer was down 17.68% through the end of September. The peer group, so the average diversified emerging markets fund in Morningstar's database, was down about 14%, or a little more. So Oppenheimer's been lagging a little bit. I figured I'd touch on this one because this one seems to have the biggest lag. But there's a couple of different reasons for it. Number one has to do with how Oppenheimer actually manages the money and what their strategy is like. So Oppenheimer has kind of a theme for the different types of stocks that they are buying, and that theme is surrounding the consumer and the consumer in emerging market countries. That if you look at China, if you look at India, if you look at Brazil, if you look at Russia, that there are these emerging middle classes that are developing, and we have more and more people with more disposable income that are going to be interested in buying goods. So the Oppenheimer Fund's strategy is to try and take advantage of that. So they tend to emphasize stocks in these countries that are going to benefit from these type of, I guess you could say, demographic trends. So, the good news is over the long haul, and we'll see that in a second, this strategy has definitely paid off. Oppenheimer's been an excellent emerging markets fund. But for third quarter and kind of much of this year, the consumer discretionary sector has not necessarily been the best performer within emerging markets. So a couple of things that I'll just sort of mention. So how does this play out? What you would find with the Oppenheimer Fund is that it has much more of an emphasis on technology names. For example, you would find things like Alibaba. You would find stocks like Baidu inside the portfolio. So that's sort of emphasizing the developing technology components in this case, it's China. Some other things that you would find inside of the Oppenheimer Fund, and these are actually not emerging market stocks, but companies like Louis Vuitton or Prada, these are also inside that portfolio. But these are high-end luxury consumer goods, which are areas of the market that Oppenheimer thinks people in China, that developing middle class, are going to be interested in buying, which is true. So, that's kind of how they're positioning the portfolio. As it so happens this year, that element has not necessarily done so well. If you look at Alibaba stock, it's down this year. If you look at Baidu stock, it's down this year. One other thing that I'll mention, and I'll move on, is they do tend to stay away from, in some of the emerging market countries, they have these sort of quasi-governmental private businesses. Justin Leverins, who runs this portfolio, doesn't particularly like those kind of stocks. So that might be some of the Chinese banks, if you will, have much more of a government influence on them. Maybe the bank is being kind of propped up somewhat by the government. So he tends to stay away from those. some of those stocks have actually done okay. So at least for this year, the strategy, whether that's the emerging consumer in emerging markets, hasn't necessarily played out, and staying away from some of these private but not really all that private types of stocks has not necessarily worked out so far this year. So that's a little bit of color on what's been happening with the Oppenheimer Fund. So I'm kind of picking one that isn't necessarily doing so well. Let's take a look at one that that is doing well. If you take a look at the T. Rowe Price New Horizons, which is at the top of this particular page. So even though it's down for the year, at least through September, down 0.62%, the average small cap growth fund was down 5.18%. So it is held up much better than its brethren. So a couple of thoughts on this one. You know, what's working well for it. So the strategy with New Horizons is basically they buy small companies, and they're looking for companies that are going to grow into, you know, the next Apple, the next Walmart, the next Amazon. They want to buy these companies early and hold on to them. The portfolio allows them, or the prospectus of the fund allows them to hold stocks of companies that they believe are going to continue to run, even if they become a medium-sized company or even a large company. So part of the reason that this one has done so well this year is because the size of the companies inside the portfolio are a little bit bigger than the average small cap growth fund out there. So the average market cap for this particular portfolio is about $4.5 billion. The peer group is closer to 2. So a couple names that I'll bring up, which I don't think are necessarily a bad thing, but the second holding in the portfolio, second largest holding, is O'Reilly Auto Parts, which is a relatively large company. That one is up about 40% year to date. They bought O'Reilly years ago and have held on to it, so it's still generating results for them. But it's more of a large cap stock as it stands right now. Another one that's in the portfolio as one of, I think it's maybe one of the top 15 holdings, is Netflix. Netflix is up 131% year to date. So definitely one that I'm sure they're happy to have held on to. But Netflix is also a relatively large company as it stands. So at least with New Horizons, and maybe you could think of this as something of a diversification measure. Yes, you know, the preponderance of the stocks in the portfolio are small companies, but they can continue to hold them if they think that the outlook is good, and that's paid off for New Horizons so far this year. So here I'm kind of looking at just really year-to-date numbers, but we can get a look at sort of the longer-term picture. The longer-term picture, looking out 3 years, a full 1 year, 3 years, 5 years. These are the percentile rankings, so small numbers are good. I would probably point people towards the 5-year column where we can see some consistency there. You know, many of the funds here are ranking in the top half of their peer group. Quite a few are actually top third or top quartile. So in the long run, over kind of longer market cycles, the majority of our funds are holding up quite well. When we look at, and for what it's worth, if we look at the target date funds, we do have quite a few people who use the target dates. Our target dates continue to perform extremely well. On a 5-year basis, the T. Rowe Price target dates are probably, if not the top performing target date fund out there, they are one of maybe 1 or 2. So the longer term results also look very sound. So these, what I've looked at up until this point has really been results through September. You might say, well, lots happened since September. That's true. That's basically what we're looking at here. So this particular chart is through the beginning of November, actually through November 11th. I look at my my notes here. So you can see what happened with the stock market when the Chinese devalued their currency, but then you can also see kind of what's happened since then. And by and large, we've made back just about everything that we've lost at this stage. So if you looked at your third quarter statement and you haven't looked at your account since then, I suggest go back and take a look. You might be pleasantly surprised. So along those lines, I thought it would be interesting to see how much change has actually happened with the different funds in our plan in basically about a month. So I have the returns here through September, but then I also have the returns through yesterday, I believe, through the 10th. And then how much change there has been, how much the market has recovered, I guess you could say, up and down the list. So pretty substantial recovery in a relatively short period of time. All right. So, one kind of takeaway from that last slide is, wow, a lot happened in basically a month. So that, I think, is a good example of volatility, that volatility exists out there. We're probably beginning to see a little bit more of it as we get further into the economic cycle. So a couple of things for people just to kind of keep in mind that might help them. Number one, I was talking about back in August, we have this big decline in the market. Is it a bear market or is it just a correction? I think as we sit here today, we know it was really just a correction. It wasn't the start of a bear market. But 3 weeks ago, 4 weeks ago, we were still trying to figure it out. Was this a sign of more bad things to come, or is this something relatively short-lived? So the bear markets tend to be bad and tend to last relatively long or longer. These short-term corrections are quick and usually come even when companies' earnings are still in positive territory. So definitely just a correction, not anything structural. I think this chart is also kind of interesting to look at. So as I mentioned before, these types of pullbacks, the market giving back some ground is very common. So the chart on the left is showing us how many times per year going back to 1990 there might be a 5% pullback. So it's interesting to see basically almost every year. I guess we just had 2 years, maybe 1995 and 1993, where we didn't have a 5% pullback. Every other year outside of that, at some point, we have this kind of dip in the market. So dips are normal. They're not necessarily anything to be concerned about. And they happen, they happen with a fair amount of regularity. The good thing about dips is that it presents opportunity. So it's interesting to see how the valuations on the stock market changed just between Q2 and Q3. So on the upper left-hand side, you can see what the PE ratios were of these different segments of the market compared to their 20-year average. So at the end of second quarter, there were quite a few of these boxes that were 100% or more, meaning they were pretty fairly valued, in some cases maybe getting a little frothy. Scroll to end of Q3, and now we have many fewer that are trading at 100% of their 20-year average. And so this is a great, looking back with some hindsight, this is a great buying opportunity. We had a blue light special sale for about a month where things got cheaper before they came back up again. So what are some things to keep in mind as we plan for volatility going forward? Number one, it is very hard to try and time the market, and staying invested does tend to pay dividends. So if we go back in time and look at other sort of recessionary periods, whether that's the Great Depression 5 years later from May 1932, the market was up 367%. July of 1982, 5 years later, up 267%. You got 1994, we got a bunch of Fed tightening, the government raising interest rates substantially. 5 years later, 251%, and then most recently, 2008, 2009, 5 years later, up 178%. So the market tends to be surprisingly elastic, as I said before. It tends to swing back quite quickly. You know, if you jump out, you jump to cash. It's easy to miss out on this. Actually, my slide before about how much the market has come up in 1 month, is a good example of that. Number two, diversification. Making sure that you don't have all your eggs in one basket. By and large, from what I see of most Dassault employee accounts, they tend to be pretty well diversified, but occasionally I do come across folks who have all their eggs in one basket. This particular chart is trying to show the importance of that, of spreading out the eggs. Whether if we go back to 2008 and we look at a few different time periods, the first being January through the market bottom of February 2009, so kind of taking all the pain from the Great Recession. If you were in cash, you were up 1.6%. If you had a diversified portfolio, basically 60% stocks, 40% bonds, you're down 35%. If you had it all in stocks, down 49.7% over that period. 5 years out, though, you can kind of see how the numbers change. And that's 5 years from the bottom. If we take 5 years from January of 2008 through the end of February, again, the numbers improve even more. So spreading out the eggs has an impact. There's a reason why we talk about diversification. The other piece to it is it's very difficult to try and figure out what type of investment is going to be the winner from 1 year to the next. They do tend to switch positions pretty frequently. So this little chart here is just kind of showing us, who was the top performer in a particular year. That's the orange. Who was the bottom performer in a particular year. That is the sort of light blue. So there is not one type of investment that is always the best performer. There was not one type of investment that is always the worst performer. So, because none of us have a crystal ball and it is very difficult to predict, you try and own a little bit of each of these different things. And then when volatility occurs, hopefully some of the components here will help preserve your portfolio. Others will help it spring back when the markets turn around. Putting kind of some numbers to that, we can look at a few different portfolios and how those numbers play out. This is over a long period of time. This is 1926 to 2012, but you can kind of get a sense for what the average returns look like if you incorporate more stocks or less stocks, more bonds, less bonds, international investments, etc. But certainly, as you add more defensive components, the bonds to the portfolio or cash, our worst 5-year return does not look too bad over that time frame, down 0.37%, versus if we were mostly in stocks or a relatively aggressive portfolio, our worst case 5-year return was about a 13% loss. So, tweaking these numbers or looking at this, I think is important just to kind of get a sense for the range of motion and kind of the high, what could be the high and what could be the low. I sort of said it before with regard to trying not to time the market. Very difficult to do and can be painful if you get it wrong. So looking at this here, if you had put $10,000 into the market back in January of 1980, that $10,000 would be worth about $500,000 today. If you miss the 5 best trading days during that 35-year time frame, you just missed 5 days, your return goes from 503,000 down, or your value goes from 503,000 down to 300,000. So you lose about $200,000 just by missing those 5 days. And it's interesting to kind of see where those numbers go as you continue to miss more of the sort of best trading days. We talked somewhat about rebalancing as well. This is another tool that you can use to keep your portfolio from becoming too top-heavy. If you don't adjust the mix in your portfolio, you can have one piece of your pie become too big or too small. So rebalancing has a way of making sure that you sell off some of the funds that have made money for you, and it also kind of forces you to buy into some funds that maybe are not doing so well right now, but might profit in the future, in which case you're buying at a relative low. So if you're using one of the target date funds, these will automatically rebalance for you. You don't necessarily have to do anything. If you've built your own portfolio, there's a couple different ways that you can actually set up rebalancing on your account through the net benefit system. There is a static rebalancing, which is essentially you plug in your target portfolio. In my example here, I wanted 70% stocks, 25% bonds, 5% cash. And then maybe every quarter or every 6 months or every year, the system will automatically look at your account and see if you are above or below those marks and get you, and if you are out of whack in some way, shape, or form, it will get you back to those target allocations. So that tool is available on Net Benefits where you can code your account to do that. And again, that is sort of the static rebalancing at a particular point in time. We'll just kind of look to see, are you at your target, or are you off, and adjust. The tactical rebalancing gives you more of a range. So it gives a little bit more latitude as to when you might want to rebalance. So again, another tool that you can use on the Net Benefit side where you can plug in these little ranges. If I want to have 70% of my portfolio in stocks, but if my portfolio becomes more than 75% or less than 65%, send me an email. And the Fidelity system will ping you to say, hey, a piece of your portfolio is out of balance. You need to go back in there and make an adjustment. So there's a couple of different ways that you can incorporate rebalancing into your portfolio. So with that, those, my hope here is to give people some context, I guess you could say, around sort of what's been happening with the markets. Certainly, I do think that we'll see a little bit more bumpiness as we go further into the future. Where we sit today with regard to kind of the economic cycle is, we're not newbies here. The economic cycle, we're midway through, towards getting towards the longer end of the expansion. We've had a 6-year bull market, so I think we will begin to see more and more of these kind of bumps in the road. As we get these bumps, we want to make sure that people are, approaching it appropriately and have the right mindset around it. So hopefully this was helpful for folks. Colin, I think I will turn it over to you to perhaps ask some questions.
Sure, and we're certainly getting some questions in. I do want to remind everybody that the question has come up a number of times. Are we recording this session? The answer is yes, and we do plan on having it posted out on rewards@3ds.com, our benefit site. Probably not today, but likely sometime tomorrow. The presentation should be posted, as well as the slide deck. First question is from your slide deck. You showed the DS investment choices, and it looks like most, if not all, of the funds had negative numbers in it. Does that basically mean that all of these, everybody's portfolios lost money this year?
By and large, through September, the answer is pretty much yes, if you had money in stocks. So really the only kind of bright spots, I guess you could say, for the types of investments that had positive returns were bonds, at least for the first 9 months of the year. So if we look at, for example, the Spartan U.S. Bond Index, for the first 9 months, that was up 1.11%, so that had a positive return. Obviously, the Fidelity Stable Value had a positive return. But really, outside of that, anytime you even touch stocks, by and large, stocks for the first 9 months had negative returns. If you look at my slide deck, on the slide that shows the returns through yesterday, I think it was, I think you'll note we have a lot more in positive territory just 1 month later. So it's an interesting slide to see how much can happen in just basically about a month. A lot can happen.
Okay. How do you think the continued long-term decline in oil prices will negatively impact the overall market? We continue to hear each week that oil prices are dropping and therefore have large impact on the energy companies. Mm-hmm. Do you see that as having a ripple effect throughout the stock market?
Yeah, I mean, ironically, I think there is a ripple effect, but it's probably a positive ripple effect. So although for those people that work for Exxon or Chevron or Transocean or Anadarko or some of these other energy companies or energy suppliers, yes, things are not going so well for them. But for the average consumer and for the economy as a whole, cheaper oil prices are a good thing. So remember, 70% of the economy is driven by the consumer. So if the consumer has more money in their pocket because they're spending less to fill up their gas tank, they're going to use that money to buy things. And so low energy prices, quite frankly, are probably a boon to the economy as opposed to a negative.
Okay. What do you say is the cause for this fourth quarter rally?
Well, I think really much of the cause is an overselling. I think the market third quarter got too freaked out. That's a technical term, but I think that's ultimately what happened. Was there was a certain degree of panic around what was happening with China, and over fearing around the competitiveness of what our goods were going to look like. So it didn't take long, particularly in October, where we had a spectacular jobs number, where the unemployment rate, we touched down at 5% unemployment. A lot of jobs created in October. I think people rethought their position. Those that had sold, those that had gotten more defensive, kind of came back and said, hey, you know what, maybe things really aren't as bad as we expect. So, it's a good example of the psychology of the market, that things are not always well thought out, and things are not always logical. And as a result, that's why you see these quick peaks and valleys. I think the slide that I had before, which shows how many times per year a 5% pullback occurs, and it happens very often, it's because quite often over the course of the year, people freak out a little bit, or the markets freak out a little bit. So, this is just another one of those occurrences. But clear heads seem to be prevailing as we stand here today.
Okay. And one of our employees uses dollar cost averaging over the long run. He continues to fund and often increase funding into stocks as stocks pull back. He's referring to a specific fund. It's the ODVYX that he's been doing the same with.
Yep.
Really, I suppose the question is about DS changing its funds from time to time, and his question is he's concerned that DS could potentially switch out this fund and result in an overall bad decision.
Mm-hmm.
Can you talk a little bit about the process that the steering committee goes through with you
Sure.
in terms of choosing the funds and
Sure.
keeping the funds?
Sure. So ODVYX is that Oppenheimer Developing Markets Fund. So that's I can see the rationale for the question here. Obviously, that one hasn't been doing so well this year. I think as we look at funds, though, the important thing for us is to basically be able to understand the why. Why is it not necessarily doing well? So if we can come up with an explanation, and the explanation seems reasonable, then typically we don't feel a need to make a change. I think, secondly, we're not looking at performance in a vacuum or looking at performance over a very short period of time. We are looking back 3 years, 5 years in time to try and get a better sense of, the overall or the longer-term results. So that Oppenheimer Fund has been a great emerging markets fund. This year, not necessarily having its best year, but you know what? More often than not, that fund has been an excellent performer. So we have a lot of confidence in it. We have a lot of confidence in the manager. They've been right way more often than they've been wrong. They've added value. If you had your money in the Oppenheimer Fund, you've done better than not only the peer group but also the index itself. So, I think we're pretty measured about when we make changes. If we're going to make a change, there's typically a good reason for it.
Okay. I believe this is from slide 20. The Invesco small cap fund. Its ranking dropped dramatically from single digits to I guess 68. Can you speak at all to that?
Yes. So I'm thinking for the Invesco is a pretty contrarian fund, so they're not afraid to go, delve into parts of the market that are not performing particularly well as a way to buy something that's cheap. I think a lot of what's happening with Invesco is back to that third rail of energy. They've had an above average energy stake, and I think they've actually been adding to some of their energy positions. So, for now, like I said, and as you could see with some of the slides, if you touch energy, energy has not been a good place. Doesn't mean that every single oil producer or oil supplier is a bad company. It's the industry as a whole is being kind of painted with a black brush because of where oil prices are. Are oil prices going to stay at $40 a barrel? Unlikely. Eventually oil prices will come back up again, and we're seeing some of that right now. Since the beginning of October, energy prices have rallied relatively meaningfully. So sometimes, especially with a value fund, that's what they're trying to do. They're trying to buy things that are cheap. If you want to buy something cheap right now, energy is cheap. There's good companies out there in the energy sector that are deeply discounted. So that's ultimately what's been happening with the Invesco fund is the energy segment of their portfolio.
Okay. One of our employees prefers investing in the index funds, and given the current market, would you recommend caution regarding the small cap and foreign indexes?
I think let's see. I think the answer is no, quite frankly, for the equity indexes. Those will kind of track along with kind of whatever the equity markets are doing. I think we may see, if interest rates begin to go up, that there could be some actively managed bond funds that begin to outperform their indexes. So we do have the Spartan U.S. bond index. If we see a protracted increase in interest rates, we might find some other bond funds out there that are doing better than the index. So I don't know if I'm preaching caution necessarily around the stock index funds. I'm not really preaching caution necessarily around the bond index. I'm just saying relative that we may come into a period of time where, up until this point, the index funds have been tough to beat. Whether it's large cap, mid cap, small cap, international, index funds have been tough to beat. I think the question, and you'll see it out there if you Google it, there's various different articles about kind of moving forward. If we have a rockier economic climate, will the indexes continue to have the same growth prospects as they've had in the past? And that, I think, remains to be seen. There may come some periods of time when actively managed funds really begin to outperform the indexes because they can kind of pick and choose. They don't have to just buy everything that's in the index itself. So remains to be seen.
Okay. Is there in essence, a cash-only option within our 401k plan?
Yes. Yeah, there's two. So there is the Fidelity Retirement Government Money Market Fund, which is a money market fund, and then there is the Fidelity Stable Value, it's the Fidelity Managed Income Portfolio, the MIP. So both of those two funds are effectively cash. They don't go up or down in value. They stay $1 per share, and they pay a little bit of interest. The difference between the two is the managed income portfolio is paying a higher rate of interest than the retirement government money market.
Okay. And for employees that are planning to retire in the next 5 to 7 years, what kind of a balance do you recommend?
I mean, typically what we'll see somebody 5-7 years out is anywhere from 60% stock and 40% bond portfolio to maybe a 50-50 stock to bond portfolio. I mean, here we get into risk tolerance and some preferences, but having some sort of a safety net built in there, I think is important. I have gotten a fair number of questions about that around, okay, well, should I have as many bonds in my portfolio if interest rates are looking like they're going to rise? I think at the end of the day, the bonds are there not necessarily to make money, but the bonds are there to try and protect against downside. And if you're 5 to 7 years out, you're probably worried more about the market falling than joy about the market rising. The downside is much more of an issue than the upside. So having some things inside your portfolio that will hold even with if we go into a recessionary period, those things I think are worthwhile having, even if we do see rates rise. Keep in mind with the rising interest rate thing, we don't expect a spike in interest rates. Our thought is we may see a rate rise in December and then maybe 2 more in 2016. So the Fed is not going to suddenly raise interest rates from 0% to 3.5% in a year, because that would kill the economy. So this is going to be, some of this is sort of a figurehead move. It's they're doing it more to make a statement than that they really think that the economy is overheating.
And Kendall, can you go back up one slide? I think it has your contact information, and the reason why is there's a few questions in here about who can employees go to for advice, and the reality is our employees are welcome to contact Kendall or anyone on the Longfellow team at any time. Sure. Certainly, obviously during normal business hours. Longfellow is located in Boston, so normal business hours, Monday through Friday, East Coast time. You can contact them and take advantage of their services really at any time, and they can meet with you, review your investments, review how much you're contributing to your plan to make sure you're meeting your retirement goals.
Mm-hmm. Colin, hopefully you can see this slide. It should be showing, but there is an if somebody wants to email us, note there is an underscore between the first name and the last name. It's a little hard to read with the underline under the entire email address, but just be aware of that.
Okay. Let's see. And this, I suppose, is going to talk a bit about the DS philosophy in terms of our investment choices, but why don't we have any ETFs to choose from in the DS offering?
Yeah, ETFs as it stands right now I have not seen an ETF 401k product. Just about all 401ks these days still use mutual funds rather than ETFs. There's a variety of reasons for that. Some of it having to do with the trading of the ETFs. So as it stands right now, there isn't an ability to offer ETFs because Fidelity's computer system doesn't have necessarily the ability to track them or trade them for a retirement plan. They can certainly do it inside your IRA account, but it raises other complications as it relates to 401k plans. So, I think we'll begin to see that in the future. Is we'll see the ability developed, but I have yet to come across a 401k plan that was made up of ETFs.
Okay, and sort of a follow-up to that question then would be, again, around the DS philosophy of investment choices. What about the ability just to purchase individual stocks or bonds?
Yeah, I think that would be kind of under the heading of a brokerage account. I think philosophically, as it stands right now, the feeling from Dassault is the point of the 401k plan is to give people sort of the basic building blocks. And I think we do have that as part of the plan, sort of the major asset classes. If people want to buy more exotic investments, whether that's individual stocks, individual bonds, if they want to buy ETFs, if they want to buy sector funds and things like that, the philosophy has been to do that outside of the retirement plan. Do that in an IRA account. Do that in a taxable brokerage account. So I don't know if we'll see that position change.
And it's really, I suppose, just around that philosophy that in essence, Dassault Systems 401k plan is not designed, or our intent is not for it to be to meet every goal or every need of every employee, but to provide that core basic investment options available, covering those the stocks, bonds, and money market through mutual funds to provide some stability and, in essence, really encouraging employees to have growth through their 401k plan, but without the same level of risk that individual stocks could have.
I agree with that.
You had shown what happened in essence if you take out the best trading days in a year. What happens if you take out, say, the worst trading days of the year? Again,
well, certainly the numbers get better. Certainly the numbers get better. I don't frankly know how much the numbers get better, but that would be. I think the challenge there is you'd have to figure out it works the same way, figuring out when to be out.
Right.
How do you avoid the worst trading days? Because most people, nobody knows when those days are going to come, and they come, and they tend to come fast and furious. If let's go back to September, or the market lost 12% in basically a month. To put that into context, if we were looking at the Dow Jones Industrial Average, I mean, it lost 2,000 points during that time frame. So basically, in a month, it went down 12%. That's a lot, but in a short period of time. By the same token, it rallied basically the same amount a month later. So the point of that slide is really what's the opportunity cost if you miss out on the upside, or if you miss out on the upside, or let's say you jump out of the market hoping to miss more downside, and then things rally. By the time you get back in, the market could be up quite a bit. So it's an interesting question. I don't know what the numbers look like if you take out all the 5 worst trading days, so to speak, or the 10 worst trading days. They'd certainly be better than the numbers that we showed.
Sure. And can you just remind everyone what the DS matching is on the 401k?
It's DS match is 50 cents for every dollar you put in, up to the first 8% of pay that you contribute.
Okay. And where can an individual find more resources about really any of the investment choices that we have? But in this case, they were asking specifically about the T. Rowe Price retirement fund.
Okay, I would go to Net Benefits, the website. If you go into the investments tab and scroll down, you'll see all these different funds listed. If you click on them, there are fact sheets, so to speak, or Morningstar data, and the data is pretty. Most everything that I presented today is that exact data. So that would be a good place to look first.
Okay. Now, somebody had just typed in it, and they were saying that I guess that they believe that the company matches 50 cents on the dollar up to the first 6%. But I do want to clarify for everyone, it is 50 cents on the dollar up to the first 8% that employees contribute. So in essence, the company match maximum would be 4%. So in case anybody's confused, that is what our
that is important.
Yeah,
that is important.
So, that again, just stressing, I suppose, the importance of contributing, again, if you're able to, contributing at least 8%, so you are getting that full company match. Let's see. We're just going to take another 1 or 2 questions. I know we're already 15 minutes past our scheduled deadline. Would DS ever consider adding any sort of environmentally friendly options, such as the Green Century Fund?
That's certainly possible. I mean, we do see some clients that have kind of socially conscious funds as part of their offering. I don't think we've had a lot of requests for them. So if that's something that people are interested in, let us know, and we can take a look at that.
Okay. And are you aware of any, or are you aware of any planning for any new features for retirement withdrawals, i.e., conversion to an annuity or monthly, quarterly withdrawal options? And I think some of those already exist.
Yeah, I think the installment payment option is available. So if you wanted to get a $500 a month and just have that deducted from your 401k account and sent out to you, I believe you can do that with the DISO plan. We don't have an annuitization feature. I don't see us necessarily kind of bringing on, well, the annuitization piece, there's a couple different formats of that. One is sort of an in-plan annuity where you kind of buy an annuity within the 401k. I don't think we'll be doing that anytime soon. The annuity piece is probably not on the table, but if you wanted a certain dollar amount each month or each quarter, you can set that up through Fidelity.
Right. But Kendall, correct me if I'm wrong, but if a person was interested in an annuity, they could pull their funds in retirement. They could pull their funds out of the DS 401k plan and set up.
Absolutely. Right. Absolutely, and that's typically what we see is, if people want to purchase an annuity, they'll just use the money in the 401k to buy one, but they might buy it from some sort of insurance company or something like that.
Okay. And this will be our last question. Can you contrast the Franklin International Small Cap Growth Fund with the Oppenheimer Development Markets Fund that you already talked about?
Yes.
What explains the positive returns for the former?
Okay, so the Oppenheimer, I think the easiest way to describe it, Oppenheimer is basically buying big companies, but in small economies. Probably the best way to describe it. Whereas the Franklin International Small Cap Growth is buying small companies in big economies. So the Oppenheimer Fund is typically buying, large companies, but in, developing countries. Whereas the Franklin is tiny companies in Germany, in England, in Italy, in Japan, in Australia or Canada. So that's part of the difference. Is it's just different stocks. It's different stocks that they're owning. I think the international. Why did the international have positive results? Part of it is, and I think those positive results. I have to look here. Bear with me. Yeah. So those positive results are the year-to-date results. It did have, the Franklin had a negative return for the quarter. It was down 4.19, but year-to-date, it's up 3.77. I think maybe the way to phrase that is it's still up 3.77 even after a 4.19% decline. So the Franklin had a very good run from the beginning of the year to maybe the beginning of second quarter. So it had kind of extra in the pot that it could dole back out and still be above water. Some of that is because if we look at 2014, the Franklin Fund had a particularly poor year. So international small cap stocks in 2014 got roughed up pretty good. So we're starting from a relatively low spot at the beginning of the year, and as the outlook for the global economy improved at the beginning of the year, things were relatively rosy. This one sprang up quite a bit because it was depressed in 2014. So I would say that is part of it. I would also say for small cap stocks, they tend to be they're going to be less impacted with interest rates of other countries. So if interest rates rise here in the United States, will that impact lending in Japan? Maybe to some degree, but it's not a direct one-to-one correlation. So it would certainly impact small cap stocks in the U.S. if rates rise. Small caps in other countries, if rates rise here, not necessarily a one-to-one relationship. So that might be part of it as well, is that people could think of Japanese small cap stocks as maybe being a little away from interest rate sensitivity. A couple of thoughts off the top of my head, but I think more of it has to do with the rally at the beginning of the year on that particular fund. Built up such a cushion that even when you took 4.19% out of it, it was still in positive territory.
Well, thank you, Kendall, again for your time today. I know we didn't get to everybody's questions, so if you still have questions or would like to speak with Kendall or someone else from the Longfellow team, please feel free to reach out. Obviously, again, Kendall's information, Longfellow's information is on the screen there for you. You are welcome to contact Longfellow at any time. Take advantage of their services. There's no cost to you, so please take advantage of their services. Again, you can do that year-round, anytime. I know that they do come on site at the larger locations once a year, but you have access to them for a phone consultation at any time. So please take advantage of that. But for now, we're going to go ahead and wrap up our call. Thank you, Kendall, again for your time today. And again, we will have this recording as well as the slide deck available on rewards@3ds.com. So thank you again.
Thank you, Colin. Thanks, everybody, for listening in.